Hello and welcome to another video by reitspro.com, a site for insightful articles, videos, and a lot more stuff on REITs and invit investing in India. My name is Gaurav Jain, and kindly stay with me till the end of this episode, and I'm sure we'll all enjoy and learn something. Thank you. In today's episode, we will talk about the returns that are generated by REITs or real estate investment trusts. Now, as you know, REITs are real estate investment trusts which invest in rent generating completed commercial assets. So, in fact, the returns that they generate are like property, which is a combination of recurring returns as well as the capital appreciation on real estate. So, what are the returns that are expected from REITs? Typically, it is said that real estate investment trusts in India have the potential to generate between 12 and 15% return, which comprises of both the aspects, the recurring return as well as the capital appreciation. These we will talk about further, how the two are generated and how the unit holder can receive the same. So the two components of annual returns or the recurring returns are about 7 to 8%, and the rest out of this 12 to 15% bracket comprises of the capital appreciation that is given. To understand this practically, we are sharing the screenshot of the three REITs which are operational in India today: the Mindspace REIT, the Brookfield REIT, and the Embassy REIT. Now, if you look at all the three REITs, there is a certain component of total returns which has been generated. And as you see, a part of it is what is denominated by the periodic returns column, where which is the amount of money you get every quarter, and that accumulates to the one highlighted in this column. So the two components of capital appreciation and recurring returns are both visible on this slide. In fact, it would be very useful to understand the total returns from the perspective of a mix of debt and equity, how it performs as a mix of debt and equity assets, and we'll take the example of Embassy REIT for that purpose. So if we split the total returns, we have the recurring returns as well as the capital appreciation, which is what we are going to look into. And the third part is how REITs have a lower volatility compared to passive equity investing. So this is the third element. So the returns as well as the risk can be evaluated now with the help of an example of a REIT, which is Embassy REIT, because that has been there for a longer time comparatively to the other two REITs. So the tax efficient nature of recurring returns in fact make it a very important area to study. And as an example, the distributions for financial year 2020-21 despite the COVID impact was more than 21 rupees for the entire year, and out of this 80% was tax free. And let's assume that you bought it at an approximate price of 350, which could have happened during the financial year. And in this example, if we go on and we divide the distribution by the price at which one bought it, we would get a return of 6% per annum. The percentage return in fact is far more because most component is not taxed. So let's just assume for a while that you are in the 30% tax bracket. So 6% divided by 1 minus 30% for the entire tax-free component gives you 8.6%. And if you factor in the 20% which is tax, the regular return of 21 rupees is taxed 20%, then the REIT regular returns can still be assumed to be 8% pre-tax. Now compare this to FDs, which give a pre-tax return of 5.5%. So that's the first part about recurring returns. The second part is just as equally interesting and useful. So the capital appreciation here, if you bought it at 350, at the end of April 2020 the price was 380 rupees approximately. in case of fixed income securities, you cannot see the capital appreciation at all. Now, the capital appreciation happens in the short or medium term because there are various factors in the stock market, or there are economic variables such as interest rate changes. But in the long term, the units definitely capture the appreciation of underlying properties. So it has been seen generally that properties appreciate over a period of time. So the price perception of underlying properties is in fact reflected in the price of REIT stocks. This means that if you have properties rising over a period of time, which they do normally, then the unit price keeps increasing. Also, additionally, the rentals also increase, and therefore the price of the commercial property increases to match up with the rental. So it's a 2-in-1 effect in this case. Lastly, the lower volatility makes REIT a very interesting asset to get into. So for longer time durations of 5 to 10 years at least, let's just assume that Nifty has a ballpark of 13 to 15. The assumption is based on entry and exit points averaging out very high or very low periods. REITs, as we have been discussing, give a 12 to 15%. So just let's take it as 12 to 14% as a ballpark. Now, the lower volatility comes in because REITs are mainly giving a large part of their returns by regular returns, whereas Nifty index or index investing, the large part of returns comes from capital gains. So in case of Nifty ETF investing, probably the timing of entry and exit matter a lot, whereas in REITs the volatility tends to be much lower in terms of the price points at which you enter or exit, because a lot of it is given because of regular returns. The total returns of 12 to 14%, a large part is formed from regular returns. So to conclude, REITs give a return between 12 to 15%. Secondly, REITs have a component of regular returns which could very well be pre-tax around 8%. And thirdly, they capture capital appreciation of the underlying properties also. And fourthly, they tend to have a lesser volatility than the passive strategy for equity investing.